Hey there, good morning. Thank you for tuning in to this one's market update. So you may or may not have noticed recently all the headlines talking about mortgage rates and how high they are getting. And well, yes, it is true. Mortgage rates are certainly on the high side. We're pretty much in the same place that we were last October, November, last fall, when we actually started seeing downward pressure on home prices, about 10 to 15%, I would estimate, depending on the market, but most markets here in Southern California. And today, with that same 7.5% rate, 30-year fixed conventional loan, we're not seeing prices go down. And this is largely because of inventory levels. So in today's market, we've got nearly 50% less homes available for buyers to choose from compared to last October, November. So we're not seeing prices go down in most markets here in Southern California. And in some markets, we're actually seeing prices go up. Now, I'm not trying to be a total negative Nancy in this video. I did want to share that there are some positive options if you are thinking about purchasing a home right now, and at least in the foreseeable future, because I don't think there's any expectation that things are going to be changing anytime soon, just looking at recent inflation numbers. So if you've been thinking about getting in the market, you have a couple of options. And one I've talked about on a previous video, and this was the 2-1 buy down, where the interest rate is bought down for 2 points lower than market rate for the first year, 1 point lower than market rate for the second year, and then for the third year, it just reverts back to whatever market rate is. Now, this is a product that in this higher interest rate environment, a lot of sellers are just offering this to buyers up front as part of the deal. And if they're not offering it, there's a good chance you're going to be able to negotiate it into the deal and get the seller to pay for that for you, which is, depending on the loan amount, could be anywhere from $10,000 to $15,000. Now, the other option I've been seeing a lot more of, and I expect to see a lot more of it going forward, are adjustable rate mortgages. And you've probably seen this somewhere, ARM, A-R-M. And these have a little bit more risk associated with them. But if you're someone that can tolerate a little bit more risk, then this is definitely an option worth looking at. And these loans will be fixed for a few years. And then after their, let's call it 3-year period, it will adjust based on an index that's determined once the loan is actually originated in the beginning. So there are a couple of options out there to help you mitigate some of the extra cost in this higher interest rate environment. If you've got any questions on those, want more info, feel free to let me know. And there's Lola. Thank you for watching. We'll see you on the next one.